Here's the thing nobody's telling you about your retirement account. Not the ultra scary doom scroll version, the structural version about what's real. The one where you look at the actual mechanics of what's happening and realize the risk isn't theoretical anymore. In 2008, less than 5% of mortgages went bad. 5%. That's it. And that was enough to collapse the entire global financial system. Banks failed, markets cratered, millions of people lost their homes, their savings, their jobs, all from a crack in one small corner of the market. Right now, there are cracks in several corners all at once. So let's talk about what's actually happening, why it matters for anyone with a 401k or a career in the next 5 years, and what you can actually do about it. The private credit market is where the story starts. Most people have never heard of it, and that's the problem. When you think about lending, you start thinking about banks. Banks are deposits. They lend money. The government regulates them. There are rules about how much risk they can take on, and that's a very visible system. But over the last 20 years, a shadow version of that system has been quietly growing in the background. Companies like Blackstone, Apollo, Blue Owl, and RA started doing what banks do, lending money to businesses, except without the oversight, without the transparency, and without the liquidity requirements that banks have to follow. So where did they get their money? From pension funds, insurance companies, and everyday investors with 401ks. They pooled that money, lent it out at higher interest rates, earned better returns during an era of cheap money, and the whole thing looked like a pretty good deal. So more money kept piling in, and more and more and more. The private credit market went from basically nothing to somewhere around $3 trillion roughly in a decade. The IMF's own 2024 financial stability report pegged it at 2.1 trillion and projected it to hit 3.5 trillion by 2028. The growth was 800% faster between 2012 and 2023, according to Preqin. That is 800% in just 10 years. You already know that fast growth in finance can eventually mean fast problems, but what you're probably missing is the specific mechanic that makes this dangerous right now. These aren't liquid investments. When you put money in a bank account, you can take it out tomorrow. When pension funds and retirement portfolios put money into private credit funds, those funds lend it out in long-term illiquid contracts. The money is tied up. You can't just call it back. That worked fine when everyone is calm and returns look good, but it stops working the moment people get nervous. Blackstone runs the world's biggest alternative asset manager. Their private credit funds hold $82 billion. In late 2023, redemption requests came in so fast and so heavy that Blackstone had to dip into their own money and reportedly their own employees' personal money just to cover the gap. They capped withdrawals at 5% of net asset value per quarter. And investors who wanted out were told you can have a little bit, but not all of it. Blue Owl went further. They stopped redemptions entirely on one of their retail funds. BlackRock started limiting withdrawals too. Jamie Dimon, the CEO of JP Morgan, got on an earnings call and said, I probably shouldn't say this, but when you see one cockroach, there are probably more. That's not a reassuring statement from the head of the largest bank in the United States. S&P Global reported that default rates on private credit loans doubled between 2022 and 2024, still historically low at 3.4%, but moving in the wrong direction. The Bank for International Settlements found that non-bank financial intermediaries, which is the category these private credit funds fall into, hold assets equivalent to nearly 50% of global GDP and operate with far less liquidity buffer than regulated banks. And these stocks of the companies running these funds, Blackstone, KKR, Ares, Apollo, Carlyle, Blue Owl, have been selling off hard. This is not a rumor or a prediction. This is what's happening right now. Now, here's the part that connects all of this to you, your job, your career, and your income. So think about a homeowner who bought a house for $500K and they put $50K down and borrowed the other $450. They leveraged it 10 to 1. If the house drops 10% in value, they've lost 100% of their equity. The math is brutal at scale. Now zoom out. That same homeowner has a mortgage from a bank. The bank is leveraged because the bank borrows money to lend it to us. The bank's mortgage loan gets packaged into instruments that private credit funds hold. Those private credit funds get their money from insurance companies and pension funds, which are themselves leveraged. And the government, sitting at the top of all this, is carrying $38 trillion in debt. Every layer of the system is borrowed against the layer below it. The total U.S. debt, public-private combined, is currently around 350% of GDP, higher than it was before 2008, according to the National Bureau of Economic Research. This is why 4.5% of bad mortgages was enough to take the whole thing down in 2008, not because 4.5 is arbitrarily scary, but because the leverage underneath it turned a small shock into a catastrophic cascade. The question right now is, what small shock triggers the next one? And there are actually three candidates. The first is U.S. oil. UC San Diego economist James Hamilton did the landmark research on this. 10 out of 11 US recessions since World War II were preceded by oil spikes. That's not a coincidence. This is a pattern. In 1973, oil embargo, prices quadrupled, recession followed. 1979, Iranian Revolution, prices doubled, recession followed. 1990, Gulf War, oil sparked, recession followed. 2000, oil doubled, recession followed. 2007, oil went from 60 to 147 a barrel, the worst recession since the Great Depression, followed. The reason oil works as a recession indicator is that it's an input cost for almost everything: food, manufacturing, shipping, transportation. When oil goes up, the cost of making and moving stuff goes up. Businesses get squeezed, they cut costs, they cut people. Right now, the Strait of Hormuz is under pressure. The waterway handles roughly 20% of all global oil trade, according to the U.S. Energy Information Administration. Any sustained disruption there would be the largest supply shock since the 1973 embargo, and the usual safety valve, the Strategic Petroleum Reserve, has been drawn down from 638 million barrels in 2020 to around 395 million barrels, which is a 38% reduction. So the buffer is thinner than it's ever been going into a potential supply shock. The second candidate is the Federal Reserve's shrinking room to maneuver. Every previous time oil spiked and a recession followed, the Fed had a tool to fight back. It was able to cut interest rates, inject cheap money, let businesses borrow, rehire, recover. That's been the playbook for 50 years. But right now, the Fed is stuck. Oil is volatile and trending higher. If they cut rates aggressively, they risk reigniting inflation because energy costs are rising. If they hold rates to contain inflation, they can't soften the blow from a potential recession. It's a chess problem with no clean move. Fight inflation or fight employment. Both at once is not really an option when oil is doing what it's doing. The third candidate is white-collar job displacement from AI. And this is the one most relevant to everyone watching this. Goldman Sachs estimated in 2023 that generative AI could automate the equivalent of 300 million full-time jobs globally. 2/3 of U.S. occupations have exposure. The highest risk categories are legal, finance, administration, and knowledge work, white collar. The Bureau of Labor Statistics data from early 2024 showed the information sector lost 130,000 jobs year over year. Professionals and business services shed 221,000 positions. These aren't theoretical projections. Those are jobs already gone, which Luke Groman, a macro analyst, has argued that the economic chain reaction doesn't need to affect everyone. It just needs to hit enough people. The threshold he points to is an unemployment rate between 6 and 8%, and we're currently sitting at 4.4%. That means we're somewhere between 1.6 and 3.6 points away from a potential tipping point. That's not a long runway. And here's where the leverage mechanic comes back. The people most exposed to white-collar displacements are the same people most likely to have mortgages, car payments, student loans. If enough of them lose income at the same time, spending contracts, loan defaults rise, asset prices fall, and the tower of cards starts leaning. Most people assume this will be gradual enough that we can adjust to it in real time. But gradual is exactly how every previous crisis looked right before it wasn't. Now, let's talk about the spending problem because it's a third layer of all this. The US government takes on about 5.2 trillion in tax revenue per year. It spends roughly 7 trillion. The difference is 2 trillion gets added to the debt every year. The Congressional Budget Office in 2024 projects that the national debt will hit between 54 and 58 trillion by 2034. At that point, debt held by the public would be around 122% of GDP, a level we haven't seen since World War II. The government could theoretically print money to manage the debt load. They've done it before. QE, quantitative easing, is just the Fed buying government bonds and expanding the money supply. The problem is every previous round of QE happened when oil was cheap or falling. Cheap energy gave the Fed cover to print without triggering inflation. If oil is expensive and rising and the Fed prints anyways, inflation comes back harder. The very tool that they've used to fight recessions for 3 decades becomes a liability. The spending problem doesn't resolve itself. The rate path doesn't have an obvious exit, and the private credit crunch is already underway. So what does any of this mean for you specifically? If you're a mid-career professional with at least 5 to 30 years of experience, you're in what financial planners call peak accumulation years, the decade or two where the most wealth is supposed to be building. It's also the window where bad economic shock does the most career damage because you're too young to retire and often too specialized to pivot quickly. The people who came out of 2008 best were not the ones who predicted it the earliest. They were the ones who had positioned themselves with skills that were in demand during the aftermath: risk management, regulatory compliance, restructuring, financial analysis. Not because they had a crystal ball, but they had diversified what they could offer. Right now, AI is running the same script. Roles that are being automated are not the ones commanding salary premiums. roles that work alongside AI tools that interpret AI output, that manage risk in AI-driven environments, those are seeing 20 to 40% compensation premiums according to Indeed's 2024 data. The information sector is shrinking, but the roles within it that require human judgment, context, and accountability are growing. The remote work market is part of this equation too. Companies that are using AI to reduce headcount in offices are simultaneously expanding their distributed teams of specialized talent. It's not a contradiction, it's just the new modern strategy. Cut the repeatable roles and pay more for the irreplaceable ones. The mistake most mid-career professionals are making right now is waiting to see how things shake out before they take action. The problem is that by the time this shakeout is obvious, the window to reposition has already closed. It closed in 2009 for a lot of people. They waited too long. An economy built on leverage doesn't slow down gradually and then recover gradually. It runs fine right up until it doesn't, and then it moves really, really, really fast. You can look at all of this and feel powerless. The Fed's stuck, the debt's enormous, the private credit market is cracking, oil's volatile, AI is accelerating, but none of that is in your control. But your position in the market, where you can earn, where you can work, how visible you are to the right employers, that's actually one of the few variables you can control right now. If you only have 12 to 20 months to make a lot of income before things get really, really scary, would you change how you're approaching any of it? And I'd imagine the answer is probably yes. You probably would like to be more proactive, creating more interviews, potentially working 2, maybe even 3 remote jobs because you're able to be so efficient with AI and stacking a few $100,000 in the bank while you can before AI comes for all of us, right? And if that's you, if you're a professional with at least 2 to 5 years of corporate experience, we at Elevated Tech do done for you job search. We've run the job searches of over 500 people from Meta, Netflix, Airbnb, Google, ESPN, Accenture, and more. And for many people, we actually offer a 90-day placement guarantee. So if you want to see if you qualify for that, for us to help you land and stack your next remote job, click the link below. And if you're just here for great content, we'll see you in the next video.